Hello, everybody. This is John Blank, Zacks Chief Equity Strategist and Economist, and today is November the 6th, 2023. Today, I'm going to take you through Zacks Consumer Discretionary Industries and sub-industries, and we're going to be tracking the earnings and revenues made by these groups. Prior to this, we've done the consumer staples industries. Now we're going to turn to the more discretionary spending industries. Obviously, of interest to investors and traders is the earnings that are made by these groups and the path they have followed after COVID. So here we really need to talk about tracking the earnings because of the changes that have taken place with the COVID pandemic. There is no industry that has been more influenced than the consumer discretionary industry by the COVID pandemic. So part one will be the spending fundamentals over the last 10 years, broken by that COVID pandemic in the middle. Number two will be revenue growth in the forward 12-month earnings trends that are seen in the sub-industries that we've collected. We've got four major industries. We've got many sub-industries of those four industries. Finally, we'll finish with key balance sheet ratio trends. Here we can learn a lot more, from the balance sheet ratio trends about where the earnings in the business are functioning, how well they're functioning, how well they're managed. So this will be our path today, and it should be very interesting for all of you as investors and traders. All right, first off, the major consumer discretionary industries, like I said, we'll have four. And we'll study the spending fundamentals over the last 10 years. So, number one, there's been lots of consumer spending going on still. So, up at the top here, we've got consumer confidence. And over here, we have consumer credit. Down here, we got personal consumption expenditures for three industries. And over here, we have the durable, non-durable, and services breakdown for those industries. So let's go through this. Consumer confidence. Of course, the blue line will be expectations. And those expectations are pretty low. People are kind of not strong anymore about their expectations for the consumer anymore. They're actually fairly low. If we look at the total index, which is made up of the two pieces, it's basically back to a 2016 level. So not as high between 2017 to 2019, but back to the 2016 level, not the end of the world. Now, the present situation is fascinating because the present situation is the highest. And as you can see back in here, is when they really began to break up and spread out, and the present situation looked a lot higher. People were really feeling good in their present situation before the COVID pandemic. They're not feeling as good, but they're still feeling quite good. So who do we believe? The present situation, their expectations for the future, or some measure of the middle? Good question. Wider than it's been in a long time between these feelings of what is the case and what will be the case. That's basically termed worry. Over here, credit on non-revolving terms, you can see a little bump, and then it's come back to trend on non-revolving terms. But it's the revolving credit that's fascinating. Of course, it went way, way down into the pandemic with all the cash payments, and then it went way, way up as people opened. And now it's really high. And again, we've never seen this chart converge like it has. So there is an issue with consumer revolving credit. And there is an issue with expectations versus the present situation. People feel pretty good about their current situation, not so good about the future. Over here, people really are basically living on a lot of revolving credit. Curious situation. Okay, personal consumption expenditures. Where do we see this? First of all, we see the food numbers going up in a big bump here. That's the revenge travel story, people going out to eat and drink. Down here, personal clothing and shoes, you can see these picked up during the pandemic. So people were buying online big time. Personal clothing and furniture were the big items in the early going when people were closed in. They bought furniture and they bought clothing. still stayed up fairly high throughout this period as people moved back into their homes and took and acquired, changes to their wardrobes and changes to their furniture. And of course, the last part of this was the food expenditures, also quite high. Over here, durable goods. Obviously, durable goods is here, and you can see that picked up and then tailed off. So the durable goods spending, basically appliances, as we'll see later, did explode forward into that situation. So here's the non-durables, which are much more stable. And here is the services. And this is where we get a different story. First, there was goods inflation. Now we have strong services demand. So this is very critical to understand these backgrounds about consumer confidence, consumer credit, and the paths of consumer spending as they have taken place and cycled out of the pandemic from goods to services. All right, so we're also going to see the spending story from these same industries we're looking at: apparel, food and beverages, commodities, and communication, electricity, over the prices and the jobs. So what happens here? Well, first off, we can see food and beverage prices really picked up, and now they're starting to tail off as the opening took place. Here we've got electricity prices really ramped up, but now they're starting to tail off. Again, two signs of cooling prices. Here we've got electricity. Down here we got education, doesn't show us much, and here is the apparel story, which is also fairly strong, actually. So you can see that, as we know, coming out of the pandemic, there was a surge of prices for most everything. Unemployment rates. This is the 15 to 25 rates. This is the less than 5 work week rates. So let's see how durable, how long term. Of course, you do see some pickup out of the bottom here. But in general, these trends are all basically where they were before the pandemic. Nothing I would tell you that concerns me. Obviously, they've been trending up since the Fed started raising rates a little bit, but not so much that I would be concerned about at this point, when we need to see something much more dramatic out of this chart. Over here, we've got the labor force and its unemployment rate. So this is interesting in the sense you can see this narrowing and narrowing and narrowing into that COVID pandemic. And the same trend is happening here. We're getting more and more people back into the labor force, working from the civilian labor force. So that narrowing gap is critical to know is happening. And that is a very key point here, is that labor force participation is rising. And that is keeping the economy strong. Well, not only people getting jobs, but people who are not in the workforce are finding jobs when they do enter the workforce. Keep that in mind. All right, so spending, enterprise value, free cash flow, adjusted trailing 12-month, those are those two. Down here, profit margins and RD is percent of sales. First thing we want to point out here is the incredible job that free cash flow came out of the media businesses. Fascinating story. The worst, you'll see this a lot, is the leisure businesses tanked. Of course, we were all locked in our homes. So media picked up, leisure went down. And this is really critical to see here. The net margins on leisure businesses really stand out. And of course, over here, we get the RD at percent of sales because the sales fell off. It's not that the RD rose, it's the sales fell off. And you can see that here and here, leisure businesses, these three green lines are really the story of the whole thing. However, in terms of the market, enterprise values are relatively flat for those shares. So they recovered, and people basically looked through all that stuff. Is there any sign that this is gotten a play here? Not really. I mean, everything's just kind of dragging itself along in a sideways pattern, even somewhat lower enterprise values than before their COVID pandemic. All right, so here we've got CapEx and depreciation, total debt to total assets, return on capital, and balance sheet accrual ratios. Basic point here I want to put out is the debt to capital, debt to assets for those leisure companies really exploded. Of course, they took on a lot of debt during this, after the COVID pandemic, when there was no sales. So they had to run and kept their companies going on basically debt. Keep that in mind. That's the real key story here I want people to pick up on. And again, of course, you're seeing the return on capital pick up now, but it's much more depressed because of all this debt that's been piled up in the leisure industries. The key story to pick up and know about. The rest of this is somewhat noisy and not very useful. Okay, let's get into the sub-industries, the revenue growth and the earnings trends. Of course, we got to talk about the spending. We need to go from spending to revenue and make sure everything ties out correctly. So again, we've got the four major industries: home furnishings and appliances here. Leisure, of course, the one we talked about here with all their three breakouts. Media here, there's four breakouts for media. Obviously, you can see cable is the big one. And down here, you've got other consumer discretionary. We've got 7 big industries in the group. So in general, we've got 3 or 4 industries, but this one we've got 7. So you get 3, 6, 10, 17 sub-industries here to look at. Now, let's go through what's going on here. Home furnishing appliances, of course, the appliances took off as people stayed home and rebuilt their lives in their cocoons. Now that's way down, and so that pulled forward a lot of appliance spending, and now it's down. Over here, leisure and recreation, which had been so depressed, has been leading us out, as is hotels and motels. What's interesting here is the gaming. Gaming was big, sitting in a casino beforehand. Now it's not so big. This is really interesting story. Gaming, I mean, Vegas is back, but it's really on the hotels and motels and the leisure, not necessarily the gaming. People are not gaming as much as they used to. This has been very key and insight I want to point out, but I don't know that runs Vegas down to the groups that are there, because the pickup in hotels and motels and leisure generally is much stronger. Over here, cable TV. Now this is some of your streaming services. You're going to see, particularly here, a big jump up in streaming services. So what happened in media here is there's been a revolution towards streaming services, and that's being picked up. So why is media so strong after this? Because people started subscribing to a lot of media. There's a change in the business model for media that's going on here now. So we've got a lot of stories here. We get the story of the appliance build out. We've got the shift from gaming to actual hotels, and down here we've got this all these apps and people logging into streaming services. Big interesting story going on here. Here, very noisy to pick up the stories, but there's certainly a lot of them. One of them is the toys and hobbies. Hobbies, I think, is probably the key thing here. People are building hobbies. They stayed at home and they kept on with those hobbies after they got out of the pandemic. A lot of noise here, but there's a few stories you can pick up if you care to look closely. Earnings, of course, critical to make sure we understand the story. There's that appliance boom and bust. Here's that leisure build out. Hotels and motels, of course, now at all-time highs, but gaming nowhere near as strong. So there's been a huge shift, like I told, to hotels and motels away from gaming. Down here, like we talked about, there's your bump up in those streaming services. It's critical to point that out. And you can see we've had a nice run for all these industries. Down here, what is strong? Of course, again, that hobby thing, people staying home and building hobbies and toys. This is interesting to note, and keep in mind that is another trend that has come out of this. I don't often hear people talk about the amount of hobbies that have been developed over those 2 years of people staying home, but they really did develop them. Interesting stuff. All right, earnings and EBITDA. This is earnings before interest, taxes, and depreciation and amortization. So this is really pure earnings, and this is less pure earnings. So again, let's just look to the same stories we're looking at. There's that huge build out of the appliance story, of course. There is your hotel and motel story with the gaming not coming back as strong. Here you've got this story of the media conglomerates. There's your TV providers actually doing better than you would think from earnings perspective. And of course, over here, there's your handheld tools. Again, the hobbies of making and using tools is something you need to pick up on. And there's your gaming and your thing. So when we break out tools here, handheld tools, that's Black & Decker and things like that, you can see what an immense surge of interest there has been in woodworking and making things at home with tools. It's clearly been a case that there's been changing consumer behavior. Earnings pureness, I just want to point out this is earnings from the underlying businesses versus the balance sheets. So where do we see anything of interest here? Again, I'm looking at the appliance build out and drop down. There's your huge story of lots of earnings, and now not so much, kind of boom bust. And over here you've got the gaming, that actually came up and then down again. I mean, fascinating story of how gaming and then hotels now recovering. Over here, the media groups, lots to talk about in terms of earnings pureness. These are much lower. In general, you get up into the 70% range. You're doing pretty well in terms of pureness. And here's again, the really pure earnings are coming from those tools. That's a real strong business. So you want here is you want to see a pretty pure number, and we're seeing a lot of them right now. Appliances might be the exception to that rule. Cash flow, of course, cash flow is everything. And there again is your cash flow falling off by those appliance makers. Here's the leisure and recreation just skyrocketing, right? And the game income not really coming back. It's all about the hotels and motels, as we've been discussing. There's your toys and games, hobbies, and there's your tools. So again, keep that in mind. Tools, toys, games, and hobbies. Very important trend to know about. Over here, actually, like I said, the media groups are building out that strength through the streaming services. So that's also, we don't often talk enough about the streaming services and how they've changed as the pandemic emerged. Reinvestment rate. Remember that the reinvestment rate is return an investor expects to make after reinvesting the cash flows we talked about. And it is expressed as a percentage and represents the amount of interest that can be earned on a fixed income investment. So here you can see we're basically down in the 14% area. Here we've got, actually negative returns for some point in time. Here again, we've got the broadcasting cable TVs that's all having struggles after doing quite well for a while when they first opened those streaming services. There was a boom, and now it's not so strong anymore. Of course, over here, much lower, harder because of the way this chart is to figure this out. Main point here again is the reinvestment rates really high for hotels and motels, not so high for gaming like we talked about. Once again, appliances really different than any of these other stories. Appliances in particular versus furniture, very different, similar but very different stories. All right, let's get into the key balance sheet ratio trends that can also give us insight into these businesses. So number one, the return on tangible equity, ROTE. This consists of dividing a company's net income, we talked about that, that's the earnings, the bottom line as it's known, by its average shareholder equity, net of intangible assets such as goodwill. Very noisy chart here. I don't generally like this. I just want to point out what this definition is, ROTE. The more interesting one might be the return on invested capital. That assesses the company's efficiency in allocating capital profitable investments, net operating profit after tax, no PAT. ROIC gives us a sense of how well a company is using capital to generate profits. Okay, so what we're looking at again is all this corroborating evidence. There's your appliances. There's your hotels and motels. Down here, we've got, the movie TV production boom from the streaming services. And over here, we've got a precious metals boom bust we haven't picked up before. And then all the other interesting things that are going on here. Tools actually does look okay. It's in there right there. All right, so let's keep going. Asset turnover is the ratio of total sales or revenue to assets. It helps investors understand how effectively companies are using their assets to generate sales. Investors use the asset turnover ratio to compare similar companies. So we don't want to do it across industries, but within this. So within these charts is what we want. So here, again, movie production, super strong amount of revenue to assets. Hotels and motels, super strong. Down here, there's your tool guys. Again, we've talked about these groups a lot. Now, interestingly enough, the appliance groups are actually holding up on an asset turnover basis. There is a lot of sales going on. right now relative to the assets. Inventory turnover is the rate the inventory stock is sold, used, or replaced. The inventory turnover ratio is calculated by dividing the cost of the goods of an average inventory for the same period. A higher ratio tends to point to stronger sales. So again, look at this. There is a recovery in the appliance inventory turnover. Interesting. Gambling, there's now been a little bit of pickup in the inventory turnover ratio. And down here, of course, there's your streaming services also picking up. So again, just corroborating evidence here. The earnings and revenue growth metrics of Section 2, more important than this, but this is interesting. Current ratio is a liquidity ratio, ability to cover short-term obligations. So you'd like, the general of 1 or above 2, the higher you are, the more you'll be able to cover your short-term obligations. So if there's interest rate spikiness, this would be where we pick up some concerning, interesting stories. So where do we see anything of worry? Again, probably the leisure industries down here below 1. That's that debt they piled up. That's the issue here, is the debt that was created during the pandemic by these leisure and recreation industries. Interestingly, to point out, while gambling is not as strong, it does have a lot of cash on its balance sheet. It is not a situation of worry there from that perspective. Total debt. This is what I want to talk about. There it is. The leisure businesses that built it up. And here it is, a group of debt makers in the appliance businesses as well. That's the story here, not as so much the furniture groups. So that's just showing what we've already talked about, the bubbling story in these businesses. Down here, you can see that total debt and capital actually is quite good for all these businesses. They did make a lot of money. Streaming services did provide a fair amount of capital to balance sheets, and they lowered their debt to capital accordingly. All right, so I hope you enjoyed it. Fascinating stuff of how we've evolved out of the pandemic. I hope you learned the themes from tracking these trends. I hope you put them to work when you do your investing and trading going forward. If you want these slides, give us a call at 866-794-6065, or send us an email at strategycall@zackspro.com, or find us online at www.zackspro.com. This is the way to get these slides. Obviously, when we're doing top-down work in industries and sub-industries, going through revenue and earnings growth and all these balance sheet metrics, you need the slides to get the story straight. This is the detail that we can provide as a company. So once again, 866-794-6065. Email us at strategycall@zackspro.com, or find us online at www.zackspro.com. Thanks much.